And welcome back, options traders. Good morning to everyone. And I've got a question for you. Did you guarantee a profit? And I like to ask this because I hear so many traders talking about hedges and rolls and morphs, and they'll say, "Oh, I've gotten myself into a guaranteed profit. I initially spent $2. I have now collected $3 from these rolls, and so therefore I have a guaranteed profit. And hey, look, I still have this free position sitting out there." Well, it's not quite that easy to just track the cash flows because we have to say what is the resulting position. And that's why many times traders who use this method and just track these cash flows end up scratching their heads and can't figure out why their accounts seem to be losing money. So let's go find out with an example. Did you guarantee a profit? As always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is always greatly appreciated. So the example I'm going to use for this video is a butterfly spread, but there's lots of strategies where the same trap can be sprung. So let's say that you buy the 95, 100, 105 butterfly. And what that means is you are going to buy the 95 call. So that's this first strike here. You will then sell two of the center strike here, or two of the $100 calls, and then you will buy one of the outer strikes, or buy one of the 105 calls. And let's say that this is executed for a net debit of 2. Well, we can break this butterfly spread down into two vertical spreads. This is one of the many ways we can break it down synthetically. And here's what we're going to do. We're going to use this one long 95 call, and we're going to pair it up with just one of these short $100 calls. And if we do that, that would be a long 95, 100 vertical. Well, now we can take this second 100 call that's short, pair it up with the long 105 call, and that is also a short 100, 105 vertical. So the butterfly can be viewed as two vertical spreads. If we're using all calls or all puts, we have a long vertical and a short vertical. And so again, let's say that this was executed for a net debit of 2. Now what this means is that we paid a certain amount for the debit spread and we received a certain amount for the credit spread. And it's the net difference between those two that comes up to a net debit of 2. So let's say that maybe we paid $3.50 for the long spread and received $1.50 for this short spread. So this is what the long spread would look like. This is the long 95, 100. There's our bends at 95 and 100. We have a maximum loss over here of 350. And because the spread can be worth a maximum of 5, the maximum profit you can make is $1.50. So over on the short spread side, let's say that you're short the 100, 105 call spread. And in this case, let's say that we received $1.50 credit. However, because this is a liability spread, that's going to be important in a moment. Remember, you have sold the spread. You are obligated to owe the difference in strikes. So if you collected $1.50 up front, but you possibly owe the difference in strikes, or $5, then the maximum loss is $3.50. Now let's back up for a moment and say, why is this a liability spread? Well, remember, you are short the 100 call. That's that bend. You are long the 105 call. So if you have to end up selling shares for 100, which is something that might happen by being short the 100 call, and then you have the right to buy them back for 105, what's that equal? You've sold at 100, you bought them back for 105. That is a $5 loss. And that's all this vertical spread exposes you to, is a potential $5 loss. So why would anybody do it? Well, because you got paid a credit up front to accept that risk. So again, if you collect $1.50 on the short spread, then the maximum loss is $3.50. Okay, so let's combine these two vertical spreads. Let's put the long 95, 100 and the short 100, 105 together, and we get this. This is our butterfly spread, and the net would now be 2. We have spent $3.50, but we've collected $1.50 from that short spread. That's our net debit of 2. Now again, because there is a $5 difference in these strikes, the maximum payoff for this butterfly would be 5, but because you paid 2, the maximum profit you could get would be 3. So that can happen at exactly 100 would be the maximum, but you are profitable anywhere between these break evens, which happen to be at 97 and 103. So these break evens are found by taking the left strike of 95 plus the $2 debit, that's 97, or the 105 strike minus 2, which is 103. So you have some type of profit for all stock prices between 97 and 103. You've got your maximum profit at 3 if the stock is exactly 100. Okay, so this is the position that we put on, this 95, 100, 105 butterfly for 2. And now we've got a trading question. You have purchased the 95, 100 vertical and you have sold the 100, 105 vertical for a net debit of 2. That's the setup. Now let's say that you close the 95, 100 vertical right here and you get $3. You shut it down. So because you've purchased the butterfly, you have these 3 different strikes in the account. So sure, you can break these apart. You could close the 95, 100 vertical. And again, let's say that it's done for a credit of 3. So the question now is, do you have a guaranteed dollar gain? Because after all, you spent 2 for the butterfly and you've now collected 3. And this is what many traders believe. They think that they now hold the short 100, 105 vertical for a guaranteed dollar. So they think that they've got a risk graph that looks like this. So for all stock prices above 105, they have a guaranteed dollar. But what's the reality? The reality is that you're not on this black line, but instead on this blue line. So yes, you did get a net credit of $1. You spent 2 for the butterfly, you sold the vertical for 3. And that is giving you this net down here. But you still are short the 100, 105 vertical, which remember is a $5 liability. So you've got a dollar credit after all of these cash flows, but you have a $5 liability spread sitting in your account. So now your maximum loss is 4. You do not have a guaranteed gain. You have a maximum gain of $1 and a new maximum loss of $4. Well, that's a whole lot different from a maximum loss of $2, especially if you think that it's now put you into a guaranteed dollar gain. And so this is one of, again, many types of examples you could give where traders get mixed up by just watching the cash flows. Hey, I spent this and I've collected this, now I've got a guaranteed gain. And why they end up in most cases not having it. And that's because they don't understand that when you look at these individual positions, you have to realize, are they assets or are they liabilities? And that's why it's so important to understand all of the details of your options. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.